Wall Street is ignoring the most accurate risk model on Earth, nature itself. By treating liquidity flows like cross-pollination patterns, we've identified structural vulnerabilities that traditional algorithms miss. We are decoding how biodiversity loss provides a terrifyingly precise preview of systemic financial failure before the first red candle even appears. Look closely at a meadow, and you aren't just looking at nature. You're looking at an ancient architecture of survival. For millions of years, bees and flowers have engaged in a masterclass of asset management. It's called a mutualistic network, a system where different species trade resources for mutual benefit. The flower provides energy in the form of nectar. The bee provides logistics, carrying pollen to ensure the next generation of plants. But this isn't a series of isolated trades. It is a highly optimized, nested network. The most resilient ecosystems rely on generalists, highly connected species that interact with everyone, surrounded by specialists that fill niche roles. This structure creates a brilliant blueprint for resource distribution. Because the network is decentralized and diverse, a sudden shock to one plant species won't bring down the meadow. Energy keeps flowing. Now, leave the meadow behind and look at a modern trading floor. Today's hyper-connected global equity indices, like the S&P 500 or the MSCI World, mimic this exact natural balance. We like to think of human markets as cold, mechanical engines of pure logic. In reality, they behave like massive, living ecosystems. Instead of bees and flowers, we have institutional investors, market makers, and multinational corporations. Capital is the nectar. Algorithmic trading programs act like highly efficient hives, moving millions of dollars across borders in milliseconds to wherever the returns are sweetest. When a major tech stock dips, a ripple runs through the index, forcing automated rebalancing across hundreds of underlying funds. Just like our meadow, the global financial system relies on a delicate, hyper-connected equilibrium to distribute wealth, manage risk, and sustain growth. But hyperconnectivity has a dark side. We often treat market crashes as freak accidents, unpredictable black swans, or random acts of economic bad luck. They aren't. Market crashes are structural failures identical to ecological collapse. Systemic risk. When a system becomes too interconnected and uniform, it loses its modularity. What used to prevent shocks now propagates them. When an ecosystem is healthy, diversity acts as a firebreak. If a disease hits one plant, others survive. But if human intervention forces a meadow to become a monoculture, or if bees map too perfectly to only a few dominant species, the system becomes brittle. The financial world has done exactly this. By chasing ultimate efficiency, our global indices have become hyper-concentrated. The same few algorithmic strategies are run by the same giant funds, trading the exact same basket of megacap stocks. When a shock hits a highly concentrated node, it doesn't stay isolated. The network doesn't absorb the blow, it amplifies it. The panic spreads along the exact same paths designed to distribute capital. The mutualistic network instantly flips into a contagion vector. Crashes aren't malfunctions of the system. They are the inevitable mathematical consequence of a network that has traded its ecological resilience for fragile efficiency. In the web of survival, whether made of flowers or finance, the rule remains the same. Connect too loosely, and you starve. Tie ourselves too tightly together, and we fall together. In ecology, the end doesn't always start with a bang. It starts with a secondary extinction. This is the silent moment when a species disappears not because of a direct threat, but because the species it depended on is already gone. In the global indices of 2026, we are seeing the financial equivalent of this biological death spiral. The warning signs are no longer just red numbers. We look for Metric 1, decoupling of the keystone. Watch the core, the generalist assets. When the S&P 500's top 5 companies stop moving in sync with their own supply chains, the umbilical cord of the market has been cut. Metric 2, liquidity opacity. Just as a reef becomes quiet before it dies, the order books for mid-cap, specialist stocks are turning ghost white. The bid-ask spreads are widening into canyons. Why did the flash crashes of the last 18 months feel so different? Because we have systematically murdered cross-pollination redundancy. In a healthy meadow, if one bee species fails, 3 others are there to pollinate the same flower. In the 2025 crash, the introduction of sweeping global tariffs acted like a pesticide. It didn't just kill trade, it killed the alternatives to that trade. As algorithmic models chased extreme efficiency, They pruned away the unnecessary connections, the redundant paths that once kept the system stable. When the liquidity event of May 2026 hit the Scienzz and rippled back to the Nasdaq in under 5 minutes, there was no backup. The bees were gone, the flowers were closed, and the entire ecosystem was forced into a singular, catastrophic path. Our final simulation reveals the structural truth. We treat the market like a floor, but it's actually a canopy. The canopy effect. The largest, most interconnected assets, our keystone assets, hold up the entire roof of the global economy. They provide the shade under which every smaller specialist survives. When we use algorithmic modeling to simulate the removal of a single keystone asset, a major clearinghouse or a top-tier sovereign debt fund, the results are chilling. The canopy doesn't just dip, it folds. Without the keystone, the nested layers we thought were safe are suddenly exposed to the full radiation of a systemic vacuum. The failure propagates upward and downward simultaneously. In less than 300 milliseconds of simulated time, the entire financial forest collapses into a flat, two-dimensional plane of insolvency. The web is no longer invisible. It is a noose, and we are just now realizing how tightly it's been tied. Thank you for watching this video. Please like, share, and subscribe to this channel.